Sunil Subramaniam joins us. Let's connect with him. Let's say hello and good morning to him. Sunil, good morning. Thank you for joining us. How are you feeling?
Hi,
Is this as worse as it gets, or this is just the calm before the storm?
Well, I think the storm can be both ways, right? I think a positive storm can also build up. So it is a calm before the storm, because I think the election result is a key driver for the next move of the market. And the reason there's a calm is, I think that there is a by and large positive feel on the return of this government there, and there is a calm. So like I said, and if the reality turns out and they do come back with a majority, then I think there could be a strong upside from a market perspective, and the opposite if it's a surprise result.
There will be an upside even if the current administration comes back, because in the last 5 years, if you look at what they've managed to achieve, mediocre growth when global growth was benign, nothing great in terms of policy action, and the bottom line from a market standpoint is that despite hope, assumption, view and belief, earnings are not great. So if the current administration comes back, we could be in for more of the same, and if we are in for more of the same, that's not good news.
Yeah, but where I would like to look at it is that this term of the government was spent in a lot of investing in the core parts of the economy, doing fundamental changes. So I look at it as a process of you put in inputs and there are certain outputs and there are certain outcomes, right? So I think the output to input ratio, I think, has been fairly decent. The outcomes haven't followed, like demonetization. A fundamentally game-changing move, did not work because everybody jugaaded at it and got their black money out. GST, a fundamentally game-changing, but it took time for getting a coalition of all the states together, implementing that. Now we are seeing the effects. So to me, a continuance of this government means that a lot of the outcomes of the hard decisions taken in the previous 5 years should come through, number one. Number two, private consumption, right, which is, though it's slightly faltered in the last few months, has by and large been the strength of the Indian economy. But the ultimate end result of private consumption is capex building up as capacity utilization goes up. That, I think, in the next 5 years is definitely a big story. So I think that the inputs were properly at about 70-75%. I think the outputs came out at about 50-60%, but I think the next 5 years we'll see the outcomes go to 80-90%, and that is the strength of the Indian economy, which I think will reflect. And the continuance of this government will give a fillip to continuance of those good inputs and not frittering away through giveaways to the general population, right? So I think that's the perspective which I'd like to share.
It's interesting when you're talking about that 5-year scenario, Sunil, and you're talking about the input, you're obviously sounding quite positive when it comes to the growth potential, which there have been several question marks around, at least in the near term, and given the current, narrative around elections and so forth. If you are looking at it so positively, are you ignoring what we're currently seeing with regards to, a slowdown, whether it comes in consumption names, whether it's coming in discretionary names, or just all over, the fact that we're seeing a little bit of, a tempering in demand?
See, I think the tempering in demand is just a slowdown. It is not anywhere close to a recession, okay? Number two is that, see, the recent rise in the market. So when you talked about consumption, discretionary consumption, see, our outlook remains strong on these. But buying those, see, what's happened over the last 6 months, right? You take calendar year to date, is that FIIs with this growing, confidence that the India will come back, and the slowdown in the US, so liquidity outflows being strong from there, have pumped in money into the Indian markets. But domestic mutual funds, by and large, have stayed cautious through this period. So what I'm saying is that these FIIs, which sectors they have been pumping, their valuations have gone up. So in terms of allocation, while we remain confident on the economy, right, the valuations which FIIs have pushed up in certain sectors naturally makes us cautious in terms of adding on. But bear in mind that all these sectors where the FIIs have invested are something that as domestic mutual funds we have been investing over the last 2 to 3 years. So we already have significant positions in these discretionary positions and all of that, which we are holding on to. We are not going and selling them. So my perspective is that the incremental gains are not going to come from the consumption space where valuations are already discounting a growth and the recent growth is perhaps not living up to that, but in the undervalued sectors of the economy, the cyclicals, the building materials, the capital goods suppliers, the EPC contractors. I think there the valuations have a long way to go, and it's a very good time to keep picking up good quality stocks and within that space, because this, like I mentioned earlier in my earlier thing, the consumption is ultimately going to drive the capital goods cycle, and which will not be seen in the current earnings reports as they come out, but is more of a betting on the future.
Large exposure to auto ancillary. Are you still convinced that the current slowdown in the auto sector? You got the gist of my question. Go ahead.
Yes, I got the gist of your question. So yes, we are overweight to the auto pack as a fund house, and we are bullish on it. That being said, the recent numbers have been disappointing, but what we believe is that it's a combination of the fact that there was a slight slowdown, there was a buildup of inventory, and the market was also acting as if there could never be a slowdown. So the valuation does reflect a slight richness at this point of time. So while we remain overweight, we are not adding to our current overweight, but we are not reducing that overweight, we are sticking to that. So to answer your question, yes, our conviction remains high. Valuations are looking a bit rich, but we believe that the numbers of in other 2 quarters to come would ultimately justify these valuations, so we are holding on to our position.
How exactly do you think the consumer discretionary slowdown should be viewed? Imagine if there is a slowdown by Dabur, by HUL, by PNG. It is like saying that Indians have stopped consuming soaps, shampoo and toothpaste. I mean, a slowdown in consumer discretionary is a clear example of people not consuming consumer durable goods.
Yes, but part of it is also that suddenly the NBFCs have gone out of the financing space. You've got to bear in mind that the NBFC crisis, and ultimately if you look at last year's GDP growth and the year before, NBFCs played a crucial role in helping finance the discretionary consumption part of it. And I think the crisis which led to them shutting down fresh lending and the banks not yet being ready to fully step in, and banks initially tried to only buy the books from the NBFCs. I think there's a gap of lending availability out in the market which led to this slowdown. And I think as things ease up and the monsoon forecast is still looking good, I think this second half from Ganesh Chaturthi onwards, you will see a bounce back in consumption, and banks also with their lesser concerns on NPAs, and they're cleaning out, progressing fairly well. We will see them step in and also lend, and good NBFCs are now back in the market raising good quality money. I think good parentage and less of asset liability mismatch is something, and that's one thing where we have slightly changed our position from underweight to neutral, because good quality NBFCs now I think we find them quite attractive to buy in. So they are a key driver of the consumption story we have to bear in mind, because ultimately it's rate sensitive, and we believe the second half of the year the consumption will bounce back.
Sunil, hi, morning. Wanted to just get a sense on what you're seeing across the consumption space. Dabur, Britannia, all these in the quarter gone by have faced some margin pressure. They're getting hit largely by this consumption slowdown per se. But do you think in this decline is a great opportunity to perhaps buy into some of these names, because they rarely fall? Britannia, for instance.
Yeah, but I think the decline, I don't think the stock prices are fully reflecting that decline yet, because I think the FIIs being players are pumping in money. So while the numbers are disappointing, I think the stock price correction hasn't yet happened to that extent. So I would not yet say that it's the time to go in and buy. If you're holding on to a current position already, you stick to it. But this is not the time, because I think the valuations are still not attractive enough. The corrections are not there in the valuations yet.
Aisha, this really reminds me of what we saw in pharma. At the peak, the pharma P multiples were north of 40. Sun Pharma was growing at 20%, 25% plus, great return on equity business, growing without raising debt. Then came the US FDA problem. The stocks started falling. But even
until date, they've not recovered. Yeah.
But I don't think pharma stocks till about a year ago were cheap. So I think that's with consumer stocks. They have started falling. But given that business is also slowing down, they've not really become attractive for me. For, let's say a year ago, consumer stocks were available at 40 to 70 times, and the growth was there. And I was giving it a lofty P multiple. Now growth is slowing down. but the P multiple is not come down in line with what the growth is. So it was expensive. It was super expensive. It is expensive. It has not become cheap. I think that's the point Sunil is trying to send across. Am I right, Sunil?
Yes, absolutely. Perfect. Nikunj, you got it bang on.
Okay.
Tuning.
we just interact so much that I've started understanding what fund managers are thinking now. Okay, some fund managers are also thinking, Sunil, that one should right now avoid buying into PSUs. Why is that? Even though PSU stocks are cheap.
See, I think the PSUs are still the disinvestment program versus the divestment program, right? So ultimately PSU stocks will turn a good buy the day the government is willing to let go of control and truly privatize them, because they are sitting on huge amount of assets, which are not properly exploited due to the inefficiencies of public sector management. Now the process so far is that government is just keen to encash them and take money out. It's like selling family jewels, right? So for example, we launched a PSU Opportunities Fund in 2009-10, and then we shut it down a year and a half ago, because I think PSU stocks will become a good buy in those companies where there is a genuine private sector coming in, and those efficiencies and operational management issues, or the PSU managements are given the freedom to behave like private sector. That's a fundamental issue overhang which will always cause a discount to them in comparison to the rest. And I think that they are still not value buys from that perspective, because the upside, and government suddenly going and taking a huge dividend to meet their shortfall of targets, all these concerns are always going to be a hangover. So I would say, unless there is a clear path to dilution of government stake and handing over control to, or at least a PPP part, I don't think it's a blind buy.
Okay, Sunil, great to have you on the show. Thank you so much for taking the time out and speaking with us as always.